Your crypto gains just got tested by a wallet hack on day 5, and Bitcoin refuses to break below $63,000 even as yields stay above 4.69%. Tuesday, August 4th, 2026. Like and subscribe for daily market updates. Today's agenda: the market snapshot, the hack on day 5, the oil deal draining premiums, the yen move squeezing crypto, Fed holds rates steady, the stock crypto split. Up next, the hack on day 5. Let's look at the numbers on your screen right now. Bitcoin is trading at $63,822, which is up about 0.5% today. Ethereum sits near $1,871 with similar gains. But look here, oil has dropped to $79.88 after that big surge earlier in the week. Gold is holding steady around $4,118. The S&P 500 hit 7,600, and Nasdaq climbed past 25,914. The dollar index barely moved at 99.92. What does this mean for you? It means stocks are ignoring the crypto trouble entirely right now under current central bank policy, stance globally speaking across borders worldwide, including small businesses struggling with debt service payments, monthly due dates approaching quickly soon. That brings us to the oil deal draining premiums. Everything is going wrong in the crypto world right now. A wallet hack has been running for 5 days straight without resolution. Bitcoin ETFs are bleeding again as red arrows crash against support lines on charts everywhere you look. Yet Bitcoin actually rose to $63,871, up 0.64%. The dollar index just got stronger thanks to a rare intervention by the United States and Japan to prop up the yen. That is a headwind for crypto, though I prefer saying it creates challenges for digital assets right now under current central bank policy, stance globally speaking across borders worldwide, including small businesses struggling with debt service payments, monthly due dates approaching quickly soon. Which leads to the yen move squeezing crypto. A quiet diplomatic resolution regarding the Strait of Hormuz appears poised to systematically dismantle the elevated risk pricing currently embedded within global crude benchmarks under prevailing central bank policies worldwide. This global political de-escalation carries profound implications far beyond mere headline news, directly impacting small businesses that are already stretched thin by mounting debt service obligations and approaching monthly payment deadlines as cash flow tightens globally. Brent crude is currently stabilizing near $82 per barrel, following a sharp sell-off, driven specifically by the anticipation of this transit reopening agreement between Iran and Oman. Historically, when major choke points like Hormuz remain secure without active conflict premiums, energy markets revert to supply-demand underlying health rather than fear-based speculation. We saw similar dynamics in 2016, when OPEC production cuts naturally lowered prices once sanctions on Venezuela were lifted, proving that global political risk is often priced ahead of actual events. The mechanism here involves a rapid repricing of expectations of futures contracts, as traders adjust their models from war risk scenarios back to standard logistical costs, which cascades into lower refining margins and reduced revenue for upstream producers holding significant inventory in volatile regions. For investors watching energy stocks closely today, or those with direct exposure through portfolios containing oil majors, the immediate implication is a potential compression of valuation price-to-earnings ratios that have been artificially inflated by uncertainty premiums over the last 18 months. If this transit deal materializes as expected, capital will likely rotate out of defensive hedges and into growth sectors, where interest rate sensitivity remains high given current Fed stance expectations. Consequently, energy stocks you own or monitor must be evaluated not just on production volumes, but on their ability to operate profitably in a normalized price environment without the safety net of global political insurance premiums that have propped up earnings per share estimates for too long. Here's Federal Reserve holds rates steady. In an unprecedented coordination between Washington and Tokyo, central banks executed a massive intervention to arrest the yen's collapse against the dollar, injecting billions into foreign exchange markets to stabilize the currency pair. This aggressive defense successfully pushed the US dollar index higher to 99.92 today, signaling that global central bank policy is pivoting toward risk aversion rather than growth stimulation. The mechanism behind this shift involves a sudden reallocation of capital away from high-yield digital assets and into safer sovereign debt as investors anticipate tighter available cash in the market conditions worldwide. For small businesses globally, particularly those with significant dollar-denominated debt, the strengthening greenback creates an immediate headwind. Monthly service payments now consume a larger portion of cash flow just weeks before critical due dates arrive, forcing many to cut operational spending or seek emergency refinancing at punishing rates. This dynamic acts as a potent second-order effect on crypto markets. When fiat currencies strengthen and global political tensions flare unexpectedly, risk-seeking assets like Bitcoin face severe selling pressure regardless of their intrinsic technological value. Historically, similar interventions occurred during the 1985 Plaza Accord, where major economies collectively engineered currency moves that triggered prolonged bear markets for stocks and commodities alike. Today's scenario mirrors those past events, but with added digital unpredictable price swings. As central banks prioritize stability over innovation, available cash in the market drains from altcoins faster than anticipated. Consequently, investors must recalibrate their portfolios immediately, reducing exposure to speculative tokens, while holding stablecoins or traditional bonds until the global political fog clears. The current environment demands caution, as any further yen support measures could trigger a cascade of capital flight from emerging markets and digital asset ecosystems alike, leaving only the most resilient projects standing against this new wave of big-picture economic raising interest rates. On to the stock-crypto split. The Federal Reserve held interest rates steady despite inflation surging to a 3-year high, creating a paradoxical environment where the central bank's policy stance is increasingly strained globally. This divergence leaves small businesses struggling with debt service payments as borrowing costs remain elevated following the pause. Fed Chair Warsh left the rate unchanged, signaling caution rather than immediate aggression against price pressures. However, this decision came after some votes for an increase earlier in this meeting cycle finished yesterday afternoon around noon Eastern Time, highlighting a fractured committee unable to agree on the optimal path forward. Historically, such splits often precede more aggressive moves or eventual rate cuts once data confirms disinflation. Last year's rapid rate change from hiking to cutting serves as a stark reminder that holding steady may merely be a tactical delay rather than strategic stability. The mechanism behind today's move involves waiting for clearer evidence on wage growth and supply chain normalization before altering policy, but second-order effects are already visible. Currency unpredictable price swings is rising across emerging markets reliant on dollar-denominated debt, while crypto assets remain sensitive to this available cash in the market raising interest rates, even as stocks decouple from traditional inflation narratives. For concrete investor implications, portfolios must now prepare for a prolonged period of uncertainty, where yield curves could steepen unexpectedly if the Fed eventually snaps into action. Small business owners should anticipate continued pressure on cash flow margins until rates drop significantly enough to ease monthly obligations. The market is pricing in a wait-and-see approach, but that patience carries risk as inflation data continues to defy expectations and global economic conditions remain fragile under this persistent high-rate regime. Now let's look at the big picture and what to watch for tomorrow morning before markets open again. Right now, under current central bank policy stance globally speaking across borders worldwide, including small businesses struggling with debt service payments, monthly due dates approaching quickly. This divergence represents a classic decoupling driven by global central bank policies, where traditional stocks ignore crypto's unpredictable price swings entirely, while stocks rally under artificial support. Simultaneously, small businesses worldwide struggle with mounting debt service payments as monthly due dates approach rapidly. The mechanism is clear. Institutional capital flows into risk-seeking assets like the S&P 500 and Nasdaq because they offer dividends and earnings visibility that hedge against inflation fears. Conversely, Bitcoin struggles near $63,000, acting merely as a high beta bet on future available cash in the market rather than current cash flow. This dynamic creates second-order effects, where oil prices fall sharply today due to slowing demand from struggling small firms, yet the stock market ignores it, because energy stocks are often treated differently or hedged by broader indices. Historically, this mirrors the 2016-2017 period when Bitcoin surged, while traditional markets stagnated during a rate hike cycle. However, today's environment is distinct as central banks have pivoted to holding rates steady rather than hiking aggressively. This theoretically should support both asset classes, but fails for crypto due to its unique regulatory lingering pressure. For the concrete investor implication, this split demands a bifurcated strategy. Equity investors can safely deploy capital into large-cap growth, expecting stability from government bonds and corporate balance sheets. Meanwhile, crypto holders must recognize that their assets are currently priced on speculative narratives detached from real economic underlying health, like GDP or employment data. Relying solely on the stock market's upward momentum offers no protection for a portfolio heavily weighted in digital currencies, when big-picture economic challenges eventually force a synchronized correction across all risk assets, regardless of current policy rhetoric. Bitcoin maintained its support level at $63,000 today, resisting downward pressure from ongoing wallet hack concerns. Meanwhile, oil prices dropped sharply near $79.88 as reports of progress between Iran and Oman on reopening the Strait of Hormuz reduced war premiums in energy markets. The dollar index strengthened further following rare intervention efforts by Japan and the United States regarding the yen. Although inflation recently hit a 3-year high, Federal Reserve rates remained steady, while major indices like the S&P 500 largely ignored crypto volatility as yields hovered near critical levels for small businesses managing monthly debt obligations. Thanks for watching Market Pulse Daily.